Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. George Orwell once said that writing a book is a, quote, horrible, exhausting experience that one would never undertake if one were not driven by some demon whom one can neither resist nor understand. Okay then, let's all agree that writing a book is a heavy lift. Let's also agree that the personal finance advice industry is littered with gurus making outlandish statements about profit opportunities and often giving unsound advice on wealth management. With these in mind, it was a pleasure to welcome Jared Dillan back to the Alpha Exchange. Jared is the founder and editor of the Daily Dirtnap and the author of a recent book, No Worries: How to Live a Stress-Free Financial Life. While many of the podcast discussions are in the weeds on high finance topics like monetary policy, hedging, and correlation, my conversation with Jared emphasizes the basics, how to get the big decisions right, and, in the process, enjoy more peace of mind. The foundations of our discussion are debt and risk, the two main sources of financial stress in Jared's view. On the debt side, he emphasizes three critical transactions: the house, the car, and student loans. On the risk side, he advocates for the, quote, awesome portfolio, a blend of stocks, bonds, gold, real estate, and cash. While not returning what stocks have historically, this combination has considerably smaller realized drawdowns. Overall, Jared's book is easy to consume with plenty of nuggets accessible to the non-Wall Street types. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Jared Dillan. My guest today on the Alpha Exchange is Jared Dillan. He is the founder and editor of the Daily Dirtnap, a newsletter that has been a success over the past decade, and now he's an author as well, having written a couple of books. Jared, it's great to have you back on the Alpha Exchange.
Hey, thanks for having me. And by the way, the newsletter has been around for 16 years.
16 years, launched during the teeth of the financial crisis. First started as missives from your seat as the person running the ETF business at Lehman Brothers, and you've really made it quite a success, and you've really made writing a big part of your career, and you're out with a new book called No Worries, and that's going to be the chief topic of our conversation. But as we kick it off, Jared, why don't you tell us just a little bit first about the Daily Dirtnap, and then a little bit about your foray into writing and authoring several books at this point.
So the Daily Dirtnap's been around for 16 years. I launched it after the Lehman bankruptcy. It's an institution at this point. Most people have heard of it. It's a great business. I still trade and invest myself. And the funny thing is that I tell people that even if I didn't have the newsletter as a business, I would still write every day because it's a part of my process. It's how I think. It's how I crystallize my ideas. So I would still definitely do that. Writing is, I made the decision when I was at Lehman that I was going to become a writer. And as you know, most writers don't make a lot of money. I mean, even the book business, in order to survive as an author, I mean, you need to sell books that sell hundreds of thousands or millions of copies. And most people don't do that. So the economics are pretty unforgiving. But I'm very lucky that I've built the Daily Dirtnap into a sustainable business, and that provides me with a pretty good income that allows me to pursue other projects. For example, in November, I have another book coming out, which will be a collection of short stories. It's called Night Moves. And before No Worries, I had a collection of essays come out called Those Bastards. And I have the financial freedom to be able to do stuff like that. And actually, one thing I forgot to mention is that I went back to school to get a master's in fine arts and creative writing. I graduated in June from Savannah College of Art and Design. And at age 49, I got my MFA, and it really was one of the best things I've ever done.
Fantastic. You talk about writing as part of your process, and it sounds to me like you would do it anyway, even if you weren't running a newsletter. But let's just talk a little bit about the success of the Daily Dirtnap and its wherewithal through episodes of crisis, through markets that were exceedingly dull. Maybe that's the 2013, 14, 15 zero rate years. You've always found something interesting to write about. The competition for eyeballs has never been greater. There's Substack and Twitter, and everybody's got an opinion. So there's been a democratization of the printed word. So that's good, but it also makes it hard for folks like you in the sense of there's just so many pieces out there. How is it that the Dirtnap has sustained itself for such a long period of time? What do you think you've done differently to make it so enduring?
There is a lot more competition. When I started, there was Jim Grant, there was Dennis Gartman, there was a few other people, but there weren't that many people in the space. And now, gosh, there's dozens and hundreds of Substacks and newsletters and stuff. I will say it's gotten tougher, but I also don't worry about it too much. My goal isn't to have 20,000 subscribers. I'm very happy with what I have, and people find me. And I really think the one thing that sets it apart from other publications is the quality of the writing. I do not have the best financial mind in the world. I'm not even in the top 100. But what sets me apart is number one, the quality of the writing, and number two, my focus on sentiment, which I tend to do better than everybody else. That's my niche. Nobody else really does it as well as I do. And when people subscribe to me specifically for that,
I think that having been in this business myself for over 3 decades and sometimes reaching periods of exhaustion from all the content that's coming your way, making something an enjoyable read is half the battle. Obviously, the insights are critical. You want to be reading folks for whom the time you spent in engaging with the content is valuable, but also there's just something about reading something that's enjoyable to read as well. And I think you've definitely focused on that a lot. And in your latest book, which I want to turn to, I see a lot of that there, which is just breaking down a complex subject into a style that's very digestible, simple, and making it attainable for even the average person. So let's talk about no worries. You have been in high finance for a long time, the ETF business, thinking about things like volatility and market risk episodes, inflation, asset prices. And what I think you've done here is made an effort really to create a roadmap, so to speak, on the personal finance side. So maybe rewind to the motivation for writing the book. There's a lot of places you can decide to focus on in terms of what you write about. So tell us about how you came to think about writing No Worries.
well, honestly, I think personal finance is actually more interesting than institutional finance. With high finance, there's usually an optimal solution, but personal finance is actually more complex. If you think about something as simple as the decision of whether to pay down a mortgage or invest in the stock market, there's so many things you have to consider in making that decision. And around 2018, I got interested in it. So what I did was I started reading all the personal finance classics. So I read The Millionaire Next Door and Dave Ramsey's book and Kiyosaki's book and all these books. And I was shocked at how bad the advice was that people were getting on personal finance. And that persists. So I really wanted to publish the smart personal finance book, the book that was right. And it is right. Basically, the focus of the book is about financial stress. The title of the book is No Worries: How to Live a Stress-Free Financial Life. And what I discovered was a lot of the other books were focusing on how to make the most money or how to eliminate debt, but not how to minimize your financial stress. And that's really the takeaway of the book.
Yeah, that's the overriding theme is that finance and financial uncertainty can be a source of stress. And you're giving a number of different areas of advice there, one of which is, I think, as you're referencing this misselling of certain gurus who are providing advice. You start with the main premise that debt and risk are the two main sources of financial stress. And then you break that down a little bit as well. And I guess what I wanted to start with is you make the point, get the big decisions right. And that's the critical part. And you point to the house, the car, and student loans. I thought that was so simple and pretty powerful at the same time. So why don't you walk through that concept and why that's so important, the big decisions?
Well, what you see with other personal finance experts is an obsessive focus on small expenses and austerity. So I was like, okay, if buying coffee from Starbucks is really an existential threat, let's do the math. Let's do the math and see if this makes sense. So I go to Dunkin' Donuts every day when I go to work. It's $4 a day, 225 days a year. That's $900 a year. That's $36,000 over 40 years. So I will spend $36,000 on coffee over my lifetime. But if I buy a house that's 500 square feet bigger, that's an additional $100 to $200,000. Plus, the interest on that $100 to $200,000 will exceed $100 or $200,000 over the course of paying down a 30-year mortgage. And that's really the thing, paying interest. So the big decisions, the house, the car, and the student loans, the consequences of those decisions are much greater than the million small financial decisions you make on a daily basis. There's people out there that will go to a soda machine and they agonize about whether to spend $2 on a soda. And that is the stuff that just does not matter at all. We are taught that it's the little things that matter. And that's broadly true of everything, not just finance. But it's not the little things that matter. It's the big things that matter. The little things don't matter at all. And you shouldn't spend any time thinking about them.
Reminds me of there's one of those reality shows, I think it's called Extreme Couponing, where someone finds a way to get $100 free in groceries, but probably spends hours and hours accumulating these coupons. You say money is not the product of a million small decisions, but rather a few big ones. And then you go on. I love this line. You say, people aren't appropriately nervous when buying a house. They should be. So let's talk a little bit more about the big decisions, how they go wrong, maybe where some of the advice that you've seen out there already misdirects people. Maybe start with the house. It's the biggest decision in terms of the impact on your future. It obviously requires a tremendous amount of upfront payment and then ongoing payments. So there is a lot of risk in buying a house. How should folks approach this big decision?
Well, what I said in the book is that people don't really understand the risk, which is true because buying a house in this country is a fairly easy process. You get pre approved for a mortgage, and the realtor takes you to a house, and you get an inspection, you get an appraisal, and you sign the loan documents. I mean, it's complicated, but it's very simple. And if you buy a house and you put 20% down, you have 6% in transactions costs. So, really, if the price of the house goes down by 14%, you are underwater and you can't move. You have to pay to get out of the house. And 14% is not a lot. Asset prices go down 14% all the time. That might seem hard to believe now because housing has pretty much gone straight up since early 2021. But yes, housing prices can go down 14%. So it's a lot of risk. And people can't comprehend how much risk it is, which is weird because we went through this in 2008. And even just 16 years later, people have complete amnesia about how this could go wrong. So, yeah, buying a house is one of the riskiest things you can ever do. And your hands had better be shaking when you're signing the loan documents. And if they're not, you don't understand the magnitude of the situation.
And it's a very challenging circumstance these days because the expected decline in housing prices that was supposed to arrive as interest rates rose has really not happened. There's the supply issue. Everyone who's in that mortgage is going to stay in that mortgage. So you have the double whammy right now of housing prices that are high, elevated, and the financing of those houses via the mortgage is also expensive. How should someone think about the balance of trying to be careful and make a safe, wise decision with the reality that family formations are not exactly that easy to time? You can't time the housing market as you time maybe the equity market. It's just a lot more onerous. What's that trade off look like?
Well, really, what you're describing, this phenomenon where prices are high and interest rates are high, is affordability. And affordability right now is very low. Affordability in 2020 was great. So, in the book, I say that you shouldn't spend more than 25% of your income on housing costs. Because if you do, It's going to crowd out your ability to save and invest and even have fun, like take vacations. If you're spending 45% of your income on housing costs, you won't be able to do any of those things. And I also talk about how renting is not really the worst thing in the world. The number one thing I get from kids who read the book who are like 27 years old, 28 years old, they say, well, I'm 28 years old and I don't own a house yet, so I don't feel like an adult. Homeownership is a bit of a cult in this country. We have a very high homeownership rate. It's about 66%. And that's typically what people do is you talked about household formation. People get married, have kids, get a house. But renting is also an option. Renting is also an option. It's a lot less hassle. And 90% of the time, it's actually cheaper than owning a house. So I never say that people have to own a house.
So the other two big decisions that you highlight, one, the car, not nearly as big a decision as a house, but the third is student loans. And of course, that's all the time in the news with regard to student debt relief. There's a lot of folks feeling like they've got an albatross that's preventing them from doing other things because of this burden of student loans. We were taught in the same way that homeownership is supposed to be that ticket to financial freedom that a college degree was as well. And so there's a lot of rethinking on that. Lay out what you've written on the student loan front in terms of risks and how potential student loan borrowers should contemplate that.
Well, really, probably the biggest problem we have with student loans these days is the income based repayment plans. And this law was passed in 2009, 15 years ago. And basically, what it does is let's say you spend $100,000 going to school, you borrow $100,000. And ordinarily, you would owe $1,200 a month in order to amortize the principal. What the government does is they say, you're only making 45,000 a year, so we're going to means test this payment and you only owe us $300 a month. And people say, great, I'll pay $300 a month. But what they don't realize is that the interest that they're not paying is actually being added to the back end of the loan. So you see all these stories on Twitter and other places of people who they've been paying their student loans for 15 or 20 years, and the loan balance is actually bigger than when they started. In terms of fairness, I think most people disagree with that. So, really, what you have to do is if you are on one of these income based repayment plans, you have to pay down the principal aggressively and make sure you amortize it. But I do have a rubric for going to college. If you do get into a really good school like a Harvard or something like that, it doesn't really matter what it costs. You should just go. The benefits are worth it. If you go to a second tier school, then what I say is that you should have no more than $40,000 in debt, or at least any debt that you can pay off in 5 years. You have to be able to pay off your student loans in 5 years. And if you go to a third tier school, then you can't have any debt at all.
Interesting. Okay. So, as someone who's facing these trade offs in terms of going to college, are you thinking about is the student supposed to also think about what their intended area of study is in college and what they at least potentially could make income wise? Is that part of the decision tree as well?
Absolutely. Interestingly enough, I didn't talk about that in the book, but you do have to do that math. Depending on what you major in, you have to think about your earnings potential in that major. But I think one of the reasons I didn't really focus on it is because there's really only a loose correlation, I think, between what somebody majors in and what their earnings potential is. I've worked with plenty of English majors and history majors on Wall Street, and they've been very successful and they've done super well. I think just because you major in something doesn't mean that's going to be your whole life. I was a math major in college, so I guess my earnings potential was a little bit higher.
Yeah, I think that at least what I see, and I've done some teaching at my alma mater, St. John's University, and I think this is probably consistent across most schools, is that there's recognition that almost from the day you start going to college, you ought to be thinking about where you're going in terms of graduation. And so I see the schools better connected to outside firms. There could be group projects where an outside firm works with the college on a team-oriented project in which a team of students at the school is delivering some research report or some study to the outside firm. So making that connection and then making college something where, again, when you're finished, you've really got a strong idea as to where you're going. I think that's a pretty big part of it. So we started with debt and risk as the two main sources of financial stress. And we talked about debt, probably circle back on that, but let's talk about risk. So part of this discussion is around owning stocks. You make the point that there's this cult like following to the idea that just own stocks forever. But why don't you lay out how you think about risk and in what way that's a source of financial stress for folks?
The conventional wisdom nowadays is you put all your money in an S&P 500 index fund and you just ride out the ups and downs and you have a couple million when you retire. If index funds have a place for sure, but index funds, the returns are good. The returns are very good. Most active managers can't beat them. But if you invest in an index, not only do you get the returns of the index, you get the volatility of the index. So the volatility of the S&P 500 is pretty high. The market moves around 15 to 20% a year, and it's the volatility that causes you stress. And the purpose of volatility is to make people make stupid decisions. So if the market goes down, you're experiencing stress. You're like, well, it'll come back, and you're just constantly second guessing yourself. And what I found is that when you get a really big bear market, we're talking like 30% or more, then people can't hang on. They can't hang on and they will liquidate their portfolio at the worst possible time. I've seen it. I've seen it many times in my career. But even if you could hang on, even if you had the ability to hang on, why would you put yourself through that stress when there is another solution? And the solution that I propose in the book is called the awesome portfolio.
Tell us about the awesome portfolio.
Well, the awesome portfolio is 20% stocks, 20% bonds, 20% cash, 20% gold, and 20% real estate. And the interesting thing about this combination of asset classes is that it doesn't return a whole lot less than the stock market. It historically has returned 8.1% a year, but it has half the volatility of an 80/20 portfolio. And the max drawdown in any given year is 12.2%. So you look at this and you're like, all right, I can invest in this thing and it gives me about a percent and a half less than the stock market. I get half the volatility. My max drawdown is minuscule. Why would you not do this? I guess the returns add up at the end, but one of the things about investing is that it doesn't really matter what you're invested in. The most important thing is that you stay invested. So you want to be in a portfolio where you can emotionally handle the ups and downs and stay invested over time.
Yeah, there's that old saying, timing the market versus time in the market. So staying invested. It's an interesting stat you quote on this portfolio. You said the max drawdown was 12%.
Yep.
So I know the S&P, right, during the GFC was, God, it had to be close to a 50% drawdown.
From the top in 2007 to the bottom in 2009, it was 57%. But in the calendar year 2008, it was 38%.
So significant. Let's talk a little bit about, you sort of reference it there. You've got 20% in cash in your awesome portfolio. And one of the areas that you explore a little bit in the book is the option value of cash. So walk us through that statement and how it fits into thinking about maybe seizing on opportunities.
Cash is a big pile of opportunities. You can't take advantage of opportunities unless you have cash. Just for example, the house that I'm currently living in, I'm moving in about 6 weeks, but the house that I'm currently living in, I bought in 2015. I found the house, it had been on the market for 2 days, and I basically just had to write a check for the down payment. I didn't have to sell stocks. I didn't have to think about taxes. I didn't have to move money around. I didn't have to take out a loan. I just had cash and wrote a check. And that is the most powerful thing in the world. There is nothing more powerful than liquid net worth, especially cash. So, at sometimes in your life, you're going to be on vacation in Fort Lauderdale. You're going to find a condo. You're like, gosh, wouldn't it be nice if we had a vacation spot, a second home, and you can just write a check? Or somebody comes to you and they say, I have an investment opportunity. You can invest in my tractor business or you can invest in this hedge fund. You just write a check. You can take advantage of these opportunities if you have cash. If you don't have cash, you can't take advantage of these opportunities.
I think one of the themes that you hit on a couple times in the book is maybe some fallacy that you can get rich simply by controlling your expenses. Clearly, there's a thread that money is a source of stress for folks. That's why you're writing the book. But you also make the point that austerity is not the solution. You say, under austerity, money is not your friend, but is your master. So, what is the balance between not trying to save yourself to getting rich by not going to Dunkin' Donuts each day, and the reality that people have overspent? They do run large credit card balances, they're paying too much interest on that front. What's the happy medium?
Well, that's really what the book is about achieving some balance. In the book, I talk about these people called CFs and high rollers. CFs are people who spend too little, and high rollers are people who spend too much. Really, the goal is to get to a point where you're just not thinking about money on a daily basis. You're not thinking about it at all. You don't worry about it. That's the place you want to get to. Some people think about money all the time. It's funny, I was talking to a buddy of mine and he's the cheapest guy I know. And he was getting some work done on his back deck, and he was unhappy with the work and he wanted a refund. So he had paid with it with a credit card, and he made them refund it on a debit card so he could keep the points. And I'm thinking to myself, and I'm like, who thinks of that? In a million years, I would not think to do that. This is somebody who thinks about money all the time. And if you think about it, if it's a $2,000 job and $2,000 in points, it really comes down to 20 bucks. Going through all these hoops to save 20 bucks, I can't even possibly imagine it. So, yes, there are some people who just think about money all the time. And from my standpoint is money stress compounds other kinds of stress. If you have other kinds of stress in your life, whether it's marriage stress or kid stress or job stress, money stress is going to make it worse. And it's totally preventable. It's completely preventable. So it's all about how you structure your life.
As you watch the financial news shows, there's some interesting commercials that pop up during some of these shows. And striking to me that these folks even have the money to spend on these commercials. But there's one area which is your gold coins, precious metals. It typically has some version of the US's banana republic and its debt is going out of control, which certainly could be true. There's another version that say, I've gotten rich selling real estate. You should just follow this book. I can send you the book for free. These commercials are sometimes on at 2 in the morning. Not that I've seen them. There's another version which is selling currency options and earning 3% a month. So there's a lot of this stuff out there aiming to find the individual that might be down on his or her luck. And I just curious if you have any thoughts on how it is that we can reach out to the individual who might not be an expert in finance and do more of what you're doing and less of those couple of commercials I cited.
That's really the goal. I wish I knew the answer to that question. What I'm hoping is that people will hear about the book, they'll see it in the store, they'll look at the cover, they'll be like, how to live a stress-free financial life. Well, that sounds interesting. I want to live a stress-free financial life. So those commercials tend to appeal to people who don't understand how difficult it is to even make 4% above Fed funds in a given year. It's really, really hard. And I think I talk in the book, I can't really remember, but I think I talk about the virtues of getting rich slow. You can sell currency options and make 3% a month until you get hit by the black swan. So that's introducing a lot of volatility into your life, which I don't really want.
It's interesting. And I'm wondering if we start with the premise that I don't have the stats in front of me, but the average 65-year-old is really ill prepared for retirement financially. We just have not found a way to allocate enough savings, especially with life expectancies, at least potentially being longer. So there's a long road. You've got to have some resources built up if you're before retirement, but you see where this is going in terms of having too much debt and too little savings. How should someone think about the first steps in terms of trying to get back on track with the premise that a lot of the selling of solutions tends to be not exactly suitable for a lot of individuals? In other words, it's the problem solver that's seeking to get rich in the process, whether it's consolidation of credit card debt. Some of those solutions aren't really great solutions for people. How should someone think about getting back on track?
It's really just hard work, is what it is. For somebody who has a lot of debt, the only way out of it is to pay off the debt. But one thing I talk about is this idea that most people's solution to paying off debt is to cut expenses. So you're going to eat 69-cent cans of soup and you're going to eat ramen noodles and you're not going to go on vacations and you're just going to save money and pay down the debt. That's the hard way to do it. The easy way to do it is to make more money. So there's a chapter in the book called The Revenue Side. And this is true of a lot of people. For example, there are people who go to third tier law schools and they have $150,000 in debt. And they're an attorney and they're making $40,000 a year. And it's checkmate. They can't pay off the debt. Well, they can't pay off the debt if they stay working as an attorney. I mean, they can pay off the debt if they get a different job and make more money. And a lot of people never think about that. So that's called the revenue side, which is where you're not so much focusing on expenses, but you're focusing on making more money.
Yeah, and I think that ties into another aspect of your writing in this particular book, which is this idea of the abundance mentality. And you have this discussion on upside. Talk to us a little bit about that.
Well, you and I both work on Wall Street, so we think about upside all the time. A lot of people who work on Wall Street wouldn't work there if they didn't have unlimited upside. I like to do things like writing a book, for example. No worries, probably isn't going to sell a million copies. But when I was writing it, I was like, well, it could. And it's an option and had the ability to change my life. So I like to do things that give me the potential for that unlimited upside. If you're working, not to denigrate teachers, but if you're a teacher or if you work for the government in any capacity, you make what you make and you don't have any potential for upside unless you do things like invest in stocks or stuff like that. So, getting exposure to upside is a habit of highly successful people.
So there's entrepreneurs, and you make the point here that entrepreneurship can make you happier. There's a certain sense of control that the mistakes are going to be all your own and you can account for them. But also, as you say, you've got this distribution of potential outcomes, one path of which could be extremely, extremely attractive. Not everybody can be an entrepreneur, of course. There are teachers. Is there some mechanism for someone who's got a more traditional 9 to 5 job to introduce this idea of upside into how they think? Are there maybe side projects, or what's the recommendation for someone who is likely to remain a teacher but still really wants this concept of upside?
Well, there are 24 hours in the day, and you spend 8 of them working at your job. You're going to spend 8 of them asleep. There's still another 8 hours. There's other things you can do. You can be a landlord. You can sell stuff online with Etsy or something like that. The word side hustle has a negative connotation these days, but a lot of side hustles turn into successful businesses. You're doing this thing that makes you an additional 10 or 15,000 a year, but then it grows and pretty soon it doesn't make much sense for you to be even working in your job anymore and you just end up doing this full time and that's a good outcome. So when I started the Daily Dirtnap, it wasn't a side hustle. It was a complete career change. I had no net. If it failed, I was totally screwed. But that's what you got to do.
And then, last area I just wanted to ask you about around the book before asking you a little bit more about the MFA in writing. In the book, you also talk about gaining positive exposure to luck as part of the upside discussion. Talk to us a little bit more about that.
So I like to put myself in positions where I can be positively exposed to luck. And the whole reason I started working on Wall Street was because I had an informational interview on the floor of the P Coast, and somebody threw a water bottle and it almost hit me in the head, which resulted in me getting introduced to the head of a market making firm. And that's how I got my first job on Wall Street. So you say, well, I was lucky. I almost got hit by this water bottle, but I put myself in a position where something good can happen to me. And luck happens around other people. Luck will never find you in your apartment. So you have to go to conferences, you have to go to parties, you have to put yourself in a position where something good can happen to you. And that always happens around other people.
I really like that. I completely agree. Engaging with others in various forms. It could be conferences, it could be social events. It really does create some, as you say, positive exposure to luck. So that engagement is an end in itself, but also can produce lots of optionality, I think, with what you're implying. So let's finish off with your foray back into a little bit of being a student. So you've pursued and succeeded in earning an MFA in writing. Tell us a little bit about the why of that and then what that program was like.
Well, I was 46 years old and I went camping with my wife. This was in the early days of the pandemic, and we were cooped up in the house and we're like, well, let's go camping. And it was in the summer. And I went in the tent to go to sleep and I was like, oh my God, it's so hot. I can't sleep in here. So I just got out of the tent and I sat in a chair by the fire all night long and I didn't sleep. And I just thought about my future. I thought about what I was going to do. And I decided to go back and get my MFA, something I had wanted to do since I was 22 years old. And I was going to do it at age 46. I did it at SCAD, the Savannah College of Art and Design, and it was an online program. I did drive down there for my oral exams and my thesis defense, but really it was the best thing I've ever done. Actually, I wasn't the oldest student. There were people that were older than me, but it was a fantastic experience and my writing got a lot better.
Fantastic, especially 25 years after you had the initial idea. So it just, I think, reinforces the notion that sometimes things just have to materialize on their own timeline, on their own calendar, but you got it done. Well, Jared, listen, I had read No Worries. I really enjoyed it, and I really respect authors. I think that's always an extremely heavy lift. Probably I can't even appreciate it altogether, but it's great to see you out with another book, enjoying yourself and making a contribution, especially on the personal finance side.
Thanks for reading the book. I love the book. It's a great book. I want lots of people to hear about it and buy it. It's funny, in personal finance, we hear every once in a while Susie Orman or Dave Ramsey will say something really stupid and everybody makes fun of them online. And yet these people continue to just dominate the discussion on personal finance. And I think it's time for another voice, a contrarian voice. And the book is a great contribution. So thanks for reading it and thanks for having me on.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.